Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by John Bolton, who's the principal of Squirrel Mortgages, here to talk about the Auckland property market. Welcome, John. Good to see you again.
Thank you.
Look, we're coming towards the end of another year, obviously, yet another interesting year in the Auckland residential property market. We're seeing, in terms of the latest figures from REINZ, we're seeing a record high median price, sales volumes down though quite a bit from where they were a year ago. Just to have an overall view of what you're seeing out there at the moment, what are you seeing?
I guess the year started reasonably cautiously. You had the LVR limitations come in last year, and the real impact of that didn't start until probably February of March this year, when a lot of the pre-approvals that were in the system expired. Through winter, I guess, you saw a lot less activity from first home buyers. We saw a lot less activity occurring also in the Chinese market through winter. And I think generally the things that were happening this year were sort of uncertainty around the election. That was really uncertain, particularly as it got closer. The prospect of higher interest rates, the Reserve Bank was pretty much sticking to a reasonably tight forecast of increasing interest rates. And then just uncertainty around the market generally, in particular things like the LVR rules and the potential impact that would have on the market. So when you added all of those things together, I think it was creating a certain amount of caution in the Auckland market. I guess what we've seen since October is that the market has picked up again, and it's picked up reasonably significantly. So my concern at the moment is that we get a sort of a second head of steam on in this market. If you think about the drivers, we've had the new government valuations come through, which has kind of banked those gains that people thought they were making over the last 2 or 3 years. And it's been really interesting to see, the psychology of people having those increased values now sort of showing up on their rate statement. I think that's a part of it. Another part of it is that we've clearly come out with a clean election result, and probably good for the economy generally, but frustrating for people that want to see the property market sort of stay in some sort of control, is that we've certainly seen a quite significant easing in terms of interest rate forecast. And in terms of where interest rates are expected to go, it'd be fair to say now that it looks like interest rates will sort of stay around this sort of level for at least another 12 to 18 months. And that change in the interest rate forecast, I think, has certainly given people a lot more confidence to potentially get out there and buy a property.
Yeah, so it all points to a fairly sort of robust picture as we move into 2015. What are you seeing? You mentioned the LVR restrictions. They're obviously going to be around for some time yet. The Reserve Bank's made that clear. There's obviously some restrictions towards, I guess, property investors, residential property investors, that the Reserve Bank is working on. We don't quite know the detail on that yet, although they're sort of talking about having it done as a percentage of investors' income as opposed to the number of properties they own, perhaps. So I guess, what are you seeing in terms of that balance of activity among investors and the would-be first home buyers at the moment?
Well, I think the first home buyer restrictions in terms of the speed limit above 80% has worked really, really well. It's a good thing. And, for a long time I've sort of been saying that the Reserve Bank won't be in a hurry to remove it. And I think with the softer interest rate forecast, you can pretty much kiss any notion of that disappearing goodbye. It's working well in a fairly benign interest rate environment. As far as property investors are concerned, look, I think the number of properties thing clearly wouldn't work. There's too many ways around it, and we're just creating an industry that spends its time sort of trying to get around the rules. Borrowers of convenience would be a particular example, where properties are basically purchased in family members' names to get around the numbers restriction. I think a servicing-based calculation makes sense and would work particularly well. If there's an issue in the New Zealand mortgage market, it tends to be around servicing. You'd be surprised how low the non-property related income is for a number of people that buy investment properties, and there is a degree of rent reliance there. So if the Reserve Bank and the banks generally increasingly focus on servicing, then that will certainly help slow that part of the market down.
Yeah, the next thing I wanted to ask you about was the way that banks are behaving at the moment. It's obviously a relatively low growth market, sort of around 4 or 5% from their perspective in terms of mortgage growth. And they are pretty competitive, TV offers from ASB, etc. How would you sort of, I guess, categorise the behaviour you're seeing from the banks at the moment?
Look, it's a really competitive market. Housing margins are probably the lowest they've been since the start of the GFC, which just tells you that banks are aggressively competing for volume and they're prepared to sacrifice a bit of margin to do that. You've still got reasonably strong cashbacks. And I think you've got winners and losers, and what you sort of see is that jostling for market share. I think from time to time you're seeing different banks losing market share, others gaining, and then it's shifting. But it'd be fair to say price is a key driver in terms of how they're competing. You don't see a lot of other differentiation, and it just tends to resort back to offers and price. So that's certainly pretty prevalent in the market. The interesting dynamic, I think, that's sort of starting to emerge is where we're at in terms of the economic and interest rate cycles. At the end of the day, we've got low housing growth, and the housing book is the real backbone of bank profitability. They've got low growth, they're competing aggressively for it, their margins are dropping. They had a massive windfall in the market with the switching of the portfolio from fixed to floating and the margin expansion that they got during the GFC. So they've got this double whammy now. They've basically got a lot of their book converting back to fixed rates at lower margins, but they're also competing those margins down, and they're in a low growth environment. So when you kind of add all of those things together, I think the banks are going to be pretty stretched to maintain the sort of profitability growth that they've had historically. New Zealand banks are fairly lean. I don't think there's a lot of cost saving potential within the banks unless you sort of get down to cutting out bricks and mortar, and that process is going to be relatively slow. So we're going into an interesting time over the next 2 or 3 years. I certainly think that the sort of offers that we're seeing in the market at the moment won't last. I don't expect to see these sort of cashbacks and the same sort of aggression in terms of interest rates that we're seeing right now. I don't expect to see that sort of much beyond next year.
That will be interesting to see if that does change. Now I'll ask you to get the crystal ball out and tell us, what do you think is going to happen in the Auckland residential property market in 2015?
Christ, there's a crystal ball. I think we're going to have a strong summer. Look, you're already starting to see that coming out in some of the statistics in terms of record house prices, etc. There is a lack of property on the market that's going to continue for a while yet. You've got a degree of confidence there in terms of the buyers. You've got investors that have got fairly significant capital gains into their portfolio. It's a bit of a drug, really, and maybe just another property, maybe just another two. So you're going to see all of that sort of in the market. You're going to see first home buyers that are probably a little bit fearful of missing out and the market getting too far ahead of them. We're certainly seeing more activity in that first home buyer market now. So all of that sort of stuff coming together. The real risk is more money coming in from offshore, which is a real risk. And then all of that sort of...
Are you seeing a lot of that now?
Yeah, we are. Yeah, there's still a lot of money coming in from offshore. But you get all that back in the market, and I think we'll see a repeat of 2013. A real kicker with a lack of listings, a lack of supply.
And lots of demand.
Lots of demand, and probably a bit more sort of price appreciation. It has to settle down. It has to settle down. There's no way. I mean, we're increasingly seeing servicing as an issue. There's only so much debt that you can borrow before it becomes a problem. And the unfortunate situation we're in is that the Reserve Bank's kind of stuck with its ability to put interest rates up, which is why I think you'll see more macro-prudential tools coming in next year.
That would be very interesting.
Yeah.
Well, thanks a lot for that, John. That's John Bolton, who's the principal of Squirrel Mortgages, and I'm Gareth Vaughan at interest.co.nz.